Dipan Mehta joins in for a fundamental take on the markets. Hi Dipan, we have a cocktail of bad news that our markets are trying to grapple with. In your mind, which is the biggest worry that the market has and which could drag the markets below the levels that we're currently sitting on?
See, I think political uncertainty is something which markets all over the world, kind of shiver whenever it takes place. And we are seeing in the Indian context a lot of uncertainty coming through far earlier than maybe the street was expecting, and the exact color and the nature in which the various arrangements at the center are dissipating is causing a lot of anxiety in the minds of investors. And my sense is that I think the markets are also seeing beyond the next Lok Sabha election and gradually factoring in that there could be a terrible mess in terms of a hung parliament, and that could put the country back by 2-3 years or so. So we are dealing with a political uncertainty and some amount of discounting that it's not going to get solved in the near future at least, and even may persist beyond an election which may be held either end of this year or early next year.
Dipan, in your engagement with investors, are you getting the sense that given the political uncertainty, they're looking to exit out of India? Because yesterday we did get a bit of an FII sell figure in the cash market. Is that going to be a phenomenon that we need to deal with?
See, as far as domestic investors are concerned, they have not been in the market for the past several years, and even when we saw the rally earlier this year, or for that matter most of last year, domestic investors had been selling, so their allocation to equity remains at extremely low level. And I think all these kind of events which have taken place and the way the market has tanked in this month means that whatever little expectation was there that they would enter the market just gets delayed by that point of time. And the real concern, I think you're right, is the FII flows, and if those start to turn negative, then you could see markets correcting even further from these levels. But on a fundamental basis, I think we should consider the fact that the RBI gave us another 0.25% reduction in the interest rates, and we are now repo at about 7.5%. And if inflation does tend to come under control, and current account deficit also comes under to a more manageable level, maybe because of oil prices coming down, maybe because of gold prices coming down, and if the RBI cuts another interest rates by another 50 or 75 basis points for the rest of the year, then I think that markets will have a very good chance of forming a base and gradually rallying from around these levels. So apart from the political side, I think there are certain positive trends which are taking place, which of course markets are ignoring at this point of time, but we should keep a lookout for them.
In a market like this, Dipan, you would expect many of these vulnerable pockets like infrastructure, capital goods, etc. to crack. But the worrying trend is the way some of these best-in-class private sector banks are starting to move lower. We've seen ICICI Bank head below 1,000 yesterday. HDFC Bank is moving lower one day after another. Would you worry about this pocket losing its premium and a pull out of money from private sector banks now?
I think a lot of institutional interests and investments have gone to these private sector banks, and some amount of selling is to be expected in light of what has taken place politically. But I think the business models of most of these private sector banks remain extremely attractive, and I'm pretty sure that the quarterly numbers which will come out in April will again demonstrate that these companies are in fine fettle and they continue to deliver on top line and bottom line basis. And overall, I think that they've managed the last 2-3 years of whatever recession that we have seen. They have managed the NPA cycle and as well as the various domestic challenges considerably better than the PSU banks. So I think that we are seeing some technical selling, some FI-led selling maybe in these private sector banks. But I would say that these are opportunities to increase exposure to these private sector banks, and I think investors should not consider that something has changed drastically as far as their entire business operations are concerned.
Dipan, a quick word on the cement space and the continuous collapse that we're seeing, both in terms of the production data that's coming out as well as on the stock prices.
See, I think the fortunes of the cement industry are intricately linked with infrastructure spending and real estate as well as overall economic activity. And now that we've seen an ugly number as far as GDP is concerned, and I think no headway is actually being made in terms of construction or of any kind of infrastructure. So we are seeing that getting reflected in the monthly cement sales as well. And that apart, I think some fresh capacities are also expected to come about, which is why we are seeing some pressure coming through the cement companies. But I think from a long-term investor point of view, one just needs to be a little bit patient on this particular sector. I think the long-term dynamics certainly have improved, but they are facing some short-term challenges.
All right, John, it's very troubling to see the mid-cap space. You know, now names like an SKS Microfinance have cracked close to about 15% in just one fall. How does one approach it?
Yeah, I think that's the big problem as far as retail investors are concerned, and some of the sort of India dedicated FIIs are concerned, that there's a complete breakdown or meltdown taking place in the mid-cap stocks. Partly could be individual stories where there are concerns of corporate governance issues or some specific negative developments which may have taken place. But by and large, I think that mid-caps have been correcting far more sharply than the large caps, and I think it's also to do with the fact that on very little volumes we are seeing mid-caps correcting as well. So this is a phenomena which usually takes place, and when the markets are rallying and markets are stable, large caps are stable, then you will see mid caps outperforming, and the exact reverse takes place when markets are tanking like this. So this is something which investors have taken their stride, and some of the good quality mid caps companies could become quite attractive at these levels. But I think stock selection is going to be of prime importance in a time like this.
For an average investor who's looking at the market with a longer term horizon in view, Dipan, do you think this is a good time to be cherry picking, or do you think better levels will come and one should just wait for this volatility to pass through? Because even if you look at individual names, today Bharti Airtel is up 6%, but if you map it in the last 6 months, it's been so volatile, moving from 260 to 360, between October to Jan, then falling again. Is this a good time to be buying, or would you wait?
See, I think buying should not be done at one shot, and it is a gradual process, averaging lower and lower. And maybe for some good quality stocks, especially companies where there's good visibility and very little requirement for capital, little scope for equity dilution, and high corporate governance standards, there are a few of those. So if you get such kind of businesses, I think at these levels they could be quite attractive, and one could buy a bit and then wait and see how the markets are actually moving, and you have enough resources to buy even if the stocks dip further. And again, I think the outlook has to be long term, couple of years or thereabout, and not expect much of short term returns. So if that's the kind of temperament the investor has, then I think these are certainly good levels to enter the market. And as I said, stock selection is of paramount importance over here. And with the correction which we have seen, I think a lot of the attractive stocks, maybe in pharma, FMCG, consumer-oriented stocks, some of the NBFCs as well as the private sector banks have reached attractive levels, and these companies and these sectors have demonstrated significant investor appreciation return over the past several years, and there's no reason why going forward over a longer term they should not deliver. So I do feel that these are levels to do some amount of cherry picking. But I think patience is going to be the key word if anybody is looking at increasing exposure to equity in these markets.